Ladies and gentlemen, good day and welcome to Q2 and H1FY26 earnings conference call of Shoppers Stop Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pratik Patil from Dentsu Creative Investor Relations team. Thank you, and over to you, Mr. Patil.
Thank you. Good evening. Thank you for joining us on the Shoppers Stop Q2 and H1FY26 earnings conference call. Today we have with us the senior management represented by Mr. Kavindra Mishra, Customer Care Associate, Managing Director and Chief Executive Officer, Mr. Karunakaran Mohanasundaram, Customer Care Associate, Chief Financial Officer. We will begin the call with the opening remarks from the management, after which we will have the forum open for the interactive Q&A session. I must remind you that the discussion in today's earnings call may include certain forward-looking statements and must be viewed, therefore, in conjunction with the risk that the company faces. Please restrict your questions to the quarter performance and to strategic questions only. Housekeeping questions can be dealt with separately with the IR team. I would now request Mr. Kavindra Mishra for the opening remarks. Thank you, and over to you, sir.
Thank you, Pratik. Good evening, all. I have with me Karuna, our CFO, JP, our FP&A lead, and Rohit, our IR lead. Biju, our BT CEO, will join me during the questions and answer session. We have uploaded the investor presentation on our corporate and in stock exchange websites. As you observe, our investor presentation has three major divisions: our core businesses, new businesses which we have invested in the last 2 years, and our distribution business, which again we started in the last couple of years. Before I discuss the above in detail, let me start with the operating environment. Q2 was marked by sluggish growth in certain discretionary categories and consumer goods. The urban consumer was cautious due to inflationary concerns and geopolitical uncertainties. In addition to this, we also had an overhaul of GST amendments, which I believe in the long run will enable growth. Despite external challenges such as GST implementation and other market challenges, Shoppers Stop has successfully stayed ahead of the curve. This is primarily due to our focused premiumization strategy and other key initiatives which have strengthened our market position and have driven sustainable growth. As I begin the journey of Shoppers Stop performance summary, I will focus my speech on core categories, new businesses, and lastly, I will also cover our distribution business. Let me start with our core business performance. 2 years ago, we made a deliberate and strategic decision to shift our focus towards premiumization. We started this sporadically from 2020, but this time it was a complete shift. At the time, this meant rethinking our product mix, enhancing the in-store experiences, refining our brand positioning, and leaning into what we knew customers were starting to demand: a better quality, more aspirational products, and a retail experience that reflects that value. This wasn't just a cosmetic change. It required investments in everything from merchandising and sourcing to marketing and frontline staff training. We knew it would take time to show results, but we also knew that this was the direction our customers and the market were heading towards. Now we are starting to see the clear results of that strategy. Our higher-end categories are outperforming expectations. The average transaction values are increasing, and we are attracting a more engaged, loyal consumer base. And importantly, this shift is not at the expense of volume. We are maintaining healthy traffic and seeing stronger conversions, especially among shoppers who are looking for elevated value and experience. I am confident that this is just the beginning. We are now in a stronger position to scale this approach further across categories, channels, and regions, and we are confident that this will continue to drive both top-line growth and profitability. Our team is energized, our customers are responding, and we are committed to building on this momentum in the quarters ahead. The journey isn't over. In fact, we believe we are just beginning to unlock the full potential of premiumization. But the early success we are seeing reinforces our conviction in the strategy and our confidence in the direction we are heading and building the brand love through purposeful engagement. Let me give you some snippets and the results of what we did. We continue to strengthen emotional resonance with our customers through our proprietary brand IPs such as India Vets with Shoppers Stop, Gifts of Love, and Showstoppers 25. These platforms have been instrumental in creating deeper connections, resulting in higher engagement and retention. The premiumization journey is well underway. We have enhanced the in-store experience with upgraded service and launched aspirational brands across categories. Our personal shoppers continue to redefine convenience and personalization. This segment alone now contributes to 25% overall sales, a growth of 300 plus basis points. Our private brands including Stop, Kashish and Bandhya are no longer just an option, they are a preferred choice. In fact, all three of them rank among the top 10 apparel brands during this festive season. Our First Citizen Club now stands stronger than ever with 13 million members contributing to a staggering 83% of total sales, which is up 270 basis points. We have seen the highest quarterly enrollments in our history. Engagement is deeper with 69% repeat purchases and strong adoption of Black Card, around 32,000, and Silver Card, 28,000 memberships, including renewals. The results are evident. Our core business has solid results, a turnaround in motion. Let me share the numbers that reflect our execution strength. The customer entry increased by 6% like-for-like, a positive for the first time in many years. Our key KPIs continue to rise. ATV is up by 8%, driven both by ASP by 6% and IPTs by 2%. Overall sales rose by 7% with departmental store like-for-likes at 9.4%, the highest in the last 10 years. Beauty continues to outperform, up 22% with fragrances leading the charge. Watches and handbags recorded strong double-digit growth of 13% and 11% respectively. The premium product mix grew at 16%, contributing to a 375 basis points gain and now accounting for 69% of total mix. On our financial results of core business, EBITDA grew by 42% and more importantly, our profit before tax turned from losses to profit. That is from a loss of 12 crores to a profit of 9 crores, an improvement of 21 crores. Q2 was a demonstration of Shoppers Stop resilience, agility and brand strength. Our premium positioning, omni-channel model and customer-centric strategy helped us to outperform the market. From our core business, let me shift to our new businesses which are in the investment mode. We would like to take this opportunity to update you on the progress of our new businesses, Intune, which is a value fashion format, and ssbeauty.in, our digital-first beauty platform. Both ventures are currently in the investment phase and as expected at this stage, they are incurring planned losses. However, we are confident that these are strategic investments that will drive long-term value and significantly enhance Shoppers Stop growth trajectory. Let me talk about Intune, which is where we are trying to build a value fashion powerhouse. Intune was launched to tap into the high-growth value fashion segment, catering to a younger aspirational demographic. While still early in its life cycle, we are pleased to share that Intune delivered a positive like-for-like growth in Q2 from a negative like-to-like growth in Q1, which is a strong validation of its value proposition and consumer acceptance. We are continuing to expand Intune's footprint and optimize its product mix and pricing to drive efficiency and scale. Though operating losses have increased due to front-loaded investments in store openings, marketing and back-end infrastructure, these are deliberate and controlled spends aligned with our long-term vision. Let me talk about ssbeauty.in, which is to create a distinctive beauty destination. With ssbeauty.in, we are building a differentiated digital-led beauty ecosystem with a focus on curated offerings, personalization and experiential engagement. The objective is to build a strong brand identity and connect with a wider, younger audience, complementing our offline beauty business. While initial investments in technology, marketing and customer acquisition are impacting short-term profitability, these are strategic outlays to build a high-margin scalable business. We are already seeing stronger customer engagement, a growing user base and encouraging repeat behavior. We want to reiterate that both Intune and ss.beauty.in are in the early stages of their life cycle and short-term losses are not indicative of their potential. As with all our businesses, we are following a disciplined investment approach with clear milestones and robust tracking to ensure sustainable scale-up. We are confident that these businesses will turn profitable as the scale and operating leverage kicks in. They are strategically aligned with Shoppers Stop's long-term vision of becoming the most trusted and innovative omni-channel retailer. Let me talk about the distribution business. I am pleased to share that our beauty distribution business operated through Global SS Beauty has delivered outstanding performance in Q2, growing by an impressive 103% year-on-year. This marks a significant milestone in our strategic focus on beauty as a high-potential growth engine for Shoppers Stop. Our key performance indicators across the board are trending positively. This reflects the strength of our operating model, growing consumer demand, and our ability to execute with agility. During the quarter, GSSB successfully introduced several new and exclusive brands to the Indian market, enhancing our premium beauty portfolio and further differentiating our offering. These additions not only deepen customer engagement but also reinforce our leadership in the aspirational beauty segment. Looking ahead, we remain confident in the continued momentum of our beauty business and are committed to sustained growth through strategic partnerships, digital acceleration, and further store expansion. Let me talk about capital allocation. For reasons beyond our control, opening of new departmental stores were delayed this quarter. We will be opening 5 departmental stores this quarter and 4 to 5 in Q4. On Intune, we had opened 3 stores in Q2 and we expect to open 5 stores in Q3. And we are planning to open between 8 to 10 stores in Q4. Our working capital reduced by 63 crores in Q2. Now let me give you the guidance on the key strategic focus areas. As we enter the critical festive and wedding season in Q3, we are well stocked and strategically merchandised. The consumer demand indicators are positive, particularly in premium and wedding categories. We anticipate double-digit growth momentum to continue, driven by early festive demand, upswing in beauty and fashion categories, particularly in beauty, wherein it's in the peak quarter for them, and the ongoing omni-channel marketing campaigns. Shoppers Stop is no longer just a departmental store. It is becoming a premium lifestyle destination, but one that understands, serves, and celebrates the Indian customer like no one else. In closing, Q2 was a demonstration of our ability, resilience, agility, and brand strength. Our premium positioning, omni-channel model, and customer-centric strategy helped us to outperform the market. We are confident that we will continue to deliver sustainable, profitable growth while delighting our customers and creating long-term value for our shareholders. As I conclude, my team and I wish everyone a very happy Diwali and a great festive season. I am happy to have the questions along with my team. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question comes from the line of Samir Gupta with India Infoline. Please go ahead.
Hi, sir. Good evening, and thanks for taking my question. First of all, congratulations on a good set of numbers. Firstly, your comment on the value fashion as a segment, which is seeing moderation. As an industry construct, what really is happening over here? Like even the likes of the market leader here or the largest player here, Zudio, we are seeing some moderation over there. Is it that broad uptick in consumer sentiments, there is a shift happening from value to more premium, and just wanted some color on the overall industry dynamics, sir.
Thank you, Samir. Great question. So there are 2 parts to it. One is, see, if we talk about, and without commenting on the market leader, let me talk about Intune. As we expanded and as we grew our business, we also realized that we need to strengthen our supply chain, we need to strengthen the operation efficiency of the business. So what we have seen, and as I mentioned, we have seen growth from Q1 to Q2, and what we are also seeing that the current festive is also very, very strong. So while there has been moderation maybe for other players, we are seeing that once we are improving our operational efficiencies, we are seeing an uptick in demand. In fact, the festive looks very, very strong for Intune as we speak in the month of October. And what we also feel is that at the end of the day, while customers will migrate from organized, from other segments of organized to the value segment, we also see that a lot of value is happening when customers are migrating from unorganized to organized. So I think that aspirational Indian is always there, and that journey will continue to keep on happening. I don't see any issue happening there. I think it's for each of us as brands to see that what is it that was driving us before and what changes we need to make to ensure that the growth continues. So for Intune, I'm very confident as we have driven changes and as we have taken things forward, things are improving.
Got it, sir. But your broad comment on slowness in value fashion impacting growth, that is more of a one-off, you believe? Yes.
And as I mentioned, we are seeing a very, very strong festive. Yeah.
Got it, sir. That's helpful. Second question is, sir, you have given a slide on the EBITDA margins or EBITDA, sales EBITDA, etc., for the core and the non-core businesses. Yeah. I'm just looking at the EBITDA margin for the core business on the non-GAAP sales, which is coming to around 3.3% in first half. And I understand there is some seasonality in 3Q being the largest quarter, but it is still quite low versus our guidance of a mid to high single digit kind of a margin that is the aspiration, at least in the medium term. So just wanted to understand, I understand the losses in Intune, etc. might continue, but even the core, how do we get to that mid to high single digit level in the medium term?
Samir, thanks. Karuna here. I hope you can hear me. That's a great question. Yeah. See, normally what happens is Q1 and Q2 are relatively sort of a slack season, and Q3 is the one which drives a significant amount of sales. So the guidance what we have given should still hold good, because in retail the fixed expenses are fixed. So to that extent, the margins for both Q1 and Q2 are lower primarily because of that. With the sales improving in Q3, one, because of season, Diwali festive, and second, because of the end of season sale that starts in the month of December, we should be able to see a mid-single digit EBITDA margin or slightly better than mid-single digit EBITDA margin for the core business, Samir.
For 3Q, I can understand, but for a full year...
No, I'm talking for the full year. No, I'm talking for the full year. With that, we should be able to see for the full year a good EBITDA margin.
So this 3.3% for the first half is broadly in line with your own expectations. It is not running on the lower side. That's the broad understanding?
Yes. Yes.
Got it. Yeah,
yeah.
Great. That's all from me. I'll come back in the queue for follow-ups. Wish you a very happy Diwali in the meantime.
Thank you, Samir.
Thank you, Samir. Thanks.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Ashutosh Jyotiraditya with ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity, sir. So my first question would be on the value fashion. The question which the earlier participant asked, so just in continuation to that, if you think that the festive demand seems to be good and everything looks okay in the value fashion, then why are we not getting more aggressive on store opening front in Intune business?
Ashutosh, if we just go back last quarter and we speak about our guidance, we were talking about a 30 to 40 store opening plan for Intune, right? At the time, we were also reworking on our supply chain and a 2.0 version of Intune, where we were doing some changes on our store, the way they look and feel, because that's the feedback we got from our consumers. As we speak, we have been able to do those changes, and we are seeing the aggression in terms of the sales densities, right? There's always a cycle of opening of stores in terms of getting the right properties and then getting those stores up. What we have put in our commentary is something which we are 100% sure of, and you will see that as the numbers pick up, that aggression will also come in. So I'm not worried about that. For us, the important thing was that while we were expanding, we figured out there are a few things which we need to work on and improve upon, which we have done now. The early October results are fantastic. I think we'll keep on building on those and keep on. So I think, as I had put in my commentary, this is a long-term strategic investment for us. we are not shying away from it, but we just wanted to be 100% sure that the changes which we have made start, giving the results which we wanted. So that's why you see a little bit of a slowdown against what we had said before.
Okay. And sir, just to reconfirm, what I have understood is that because of these changes, there was some slowness, particularly in the value fashion segment for your company, because other value retailers like V-Mart, they have actually given decent set of same-store sales growth. So that was the only issue, and rest all things are fine for the company.
Yes. So as I mentioned, from a double-digit degrowth like-for-like in Q1, we have moved to a positive trajectory in Q2, and we will see, and we are seeing a much higher number in, it's too early, but we are seeing very, very strong numbers in October as we speak. So we believe as a team, operating team, that we have been able to understand the customer feedback, work on it quickly, and I think the results are showing now. And as I said, I can't comment on V-Mart and everybody else because they have been in business for a while. We are very young and very new in this thing, but I think whatever has to be done, we are doing that continuously and improving. So quite confident of whatever numbers we have put there.
Okay. Sure, sir. And the second thing on this core business, so it is mentioned that the LFL was 9.4%, and so what I can understand is that this result, as you said in the opening remark, that it was mostly because of the changes or the focus areas strategy which the management has decided. It is actually giving results to the company. So that is only because of this, or like in general in the premium side of the apparel business on a whole, you are seeing some customer shift happening. Is there any trend which is observed there?
Yes. So I think it's a great question. So we definitely see the premiumization as a very strong trend, but we also believe that vis-a-vis other players in the business, whether it is brands or formats, we are gaining a higher market share because our proposition of being the house of brands, being curated, being very, very strong in non-apparel, beauty. I think those things are very differentiated, and obviously we loaded all with a great personalized service to a personal shopper. I think all that is coming strong, very, very strong. And I must say our private brand business actually, and in so many calls we have been saying that private brands is not about only selling more; it's about selling in the right way and in a premium way, and I think it's really playing. So out of the 500 brands we have in apparel, in this festive, we see that our private brands are among the, like 3 of them are among the top 10, which shows the kind of work which the team has done and has been able to connect with the consumer and what they want.
Right. Understood. Thank you, sir. Thank you. Thanks a lot for this. And wish you happy Diwali to you and the team.
Ashutosh, wishing you from our side as well, to you and your family.
Thank you. Next question comes from the line of Ankit Kedia with Phillip Capital. Please go ahead.
Sir, in Intune, we saw 1% like-for-like growth, and if I adjust for early festive, probably it's negative this quarter as well. You did mention supply chain changes you have done. If you could share some examples, what were the challenges in last 2 years and how you have tried to mitigate that and what changes have you done in Intune? It would be helpful.
Okay, thanks. Thanks, Ankit. For Intune specifically, because they hardly have any presence in East. So the early festive didn't, metalize them. It was not a strong number for them.
But Hyderabad is a big market, probably.
True. Hyderabad is a big market, but we also have a very strong presence in North and Gujarat, and all of them got heavily hit by the Shraddh also coming in between. So for Intune, that number is not that much of a difference. I think in supply chain, as you rightly said, there were a lot of things in getting our supply lines stronger, getting the whole consumer promise of getting a weekly drop, ensuring that the density in the stores also increased because we went with a certain set of estimation in terms of inventory when we also looked at and spoke to the customers and got a feedback. I think we increased the choices. Then again, I think a lot of work happened on the store facade. We changed the fixtures in our stores. The brightness, the lux levels have also increased. So I think a lot of work has happened across getting the right partners, getting the frequency of delivery stronger, and then also on basis of the fixtures and the way the stores looked and feel. And I think that has started adding results to us, Ankit, and we are now building on that piece and working on that.
So last quarter, Devang had mentioned that by end of FY26, we should be break-even at the store level. Given the losses what we have this quarter, are you confident that at least at store level, Intune should break even in FY26?
Ankit, when you say FY26, are you referring to March 26, Ankit?
Yes.
No, very unlikely it will happen. See, while the first half we have reported losses, in the second half we are working on a number of initiatives to reduce the losses to almost half. So that being the case, in FY26 we don't expect at the store level to break even. Probably in FY27 we will be very, very close to break even. We may not be able to break even, but we'll be very close to break even in FY27 at the store level.
Sure. So that will be year 3 at store level break even for Intune.
That's right.
Sure. My second question is for the departmental store. Store opening continues to remain muted with a 10-year high like-for-like growth for the quarter. Don't you think we need a revision of store opening? What is, taking us back to not open stores in the departmental store despite strong footfall growth and like-for-like growth?
I would love to double the store openings. I think when we started this year, we were looking at around 6 to 7 stores. The visibility which we have, we have increased it to 9. We will keep on looking at the properties because typically these are larger stores, Ankit. Like for example, we had a plan to open 4 stores in Q2 only, right? But because of approvals, OC, various things, they got delayed. In fact, we are opening now the 2 stores which we were planning to open in Q2 are opening. One of them is opening in Ludhiana by the end of this weekend. Other in another week's time in Hyderabad. So the ability to turn around a departmental store is a variable which is not completely in our hands. Having said that, I think we should we will have between 9 to 10 stores between Q3 and Q4.
And these 9 to 10 are gross stores or net stores, Kavi, for the year?
Okay, so I think for the year. Can I just take a break? I just need to have some water. Just a sec.
Sure. Sorry.
So these are net stores. I think we are looking at not many closures or no closures at all as we speak.
Sure. Second question on departmental stores is, what is leading to this high single-digit like-for-like growth? Is it early festive years as well, which aided growth for us? And is the momentum for second half very strong, led by certain brands, certain categories? Because you did mention premium product grew at 14% versus 9% overall for departmental stores. So what kind, because other companies are not talking of this number, what we have reported. So just wanted to, double click to see, is it sustainable or it's one time, near double digit growth?
Okay. So, Ankit, what a question. I think, if you look at it continuously from Q3 last year, we have been around 5% to 6% or 4 to 5% like-for-like growth, right? When we entered into Q2 this year, we have shown a 9.4%. My July growth is around 6.5. My August actually is around 10%, and so is September. So what I'm saying is it is not only related to the festive early coming in. That's one. Second, as we enter and as we have entered into the October, and one of the fears was that October was where the festive had got preponed. So what we are seeing is that October is showing some incredible numbers of growth. And to be honest, I have not seen these kind of growth numbers in retail for a very, very long time. And I think we, as a team, we are pleasantly surprised. Now, how is it coming through? It is coming through, one, increase in customer entry. So customer entry is really, really growing very, very high. And we had a 6% like-for-like growth for the quarter, complete quarter. It is at a higher level now as we speak. So that is one. Second is, we are seeing a growth in our premium portfolio. So as you rightly said, 14% is the growth for premium portfolio, and for overall it is 9%, so it is obviously over-indexed on that. That card, which is the heart of our program, or whether it is the silver, I think the card system is really working well. The personal shoppers, where we and I remember 7 to 8 quarters back when we started talking about this, there were questions around black card means higher, the personal shoppers mean higher cost, but the investments which we have made then are now playing through. So any strategy which we do once, it takes time to execute, but I think we are in the execution stage now. It is the first stage of execution, and I think this will keep on getting built. My sense is that while we have always been conservative in talking about growth and giving estimates, but Q3 will continue to be very, very strong. October, the post Dussehra, currently as we speak, we are double-digit like-for-like growth, more than what we also did in September. And these are like very, very strong numbers. And we don't see them as one-off.
Sure. My last question is on the beauty portfolio. While we have seen strong growth in beauty distribution business, and it continues to be at a 400 plus crore run rate, but in the core EBOs and in shop-in-shop, we are not seeing growth there, right? While last quarter we did allude to high discounting, but now it's been like multiple quarters that the growth in the EBOs in beauty is just not happening, or is below the company average. So is there a thought process what we are doing here should change, or we will just let the market forces dictate terms and just sit on the sidelines here?
Hi, this is Biju here. To your question, the first point is that retail have posted mid-single digit positive growth. And if you look at it, for us, the premiumization as a journey is doing extremely well on the prestige segment, and you can see that the prestige segment is doing far ahead of the overall beauty. Acknowledge the fact that at the prestige level, the pressures still continue, and there is no different narrative. It's exactly similar to what has happened. We have decided to play on the expression, engagement, and education route, which is giving well on the prestige segment, and we continue to do well there, which is led by fragrances. Not letting go of the opportunity that may come through, because at the end of the day, the bottom funnel is very important in terms of the premiumization journey. But we are clear that we need to have sustainable and profitable growth, and hence we are focused on the prestige segment for the moment.
Did you have to just see 2-year or 3-year view on beauty? Do you think this category X of distribution business, we can grow double digit? Because last 2 years we have not been able to grow double digit in this category. And probably it is a strong pillar of growth with lots of capital being employed there. And actually the performance is disappointing. So do you think next 2 to 3 years you can turn it around and grow double digit?
Look, the fact of the matter is beauty as a segment is quite overheated. We have to acknowledge the current landscape. And if you think about it, early players who came into beauty driving business through EBOs at that time was a very profitable business. Maybe is not a very profitable business at this stage. But for us, what is a good possibility is because we have standalone. We have beauty standalone, that is EBO, brand EBO, beauty standalone, and also the SIS within the department store. I think it's not too difficult, but yes, on the standalone part, there is some strong headwinds, which we are mitigating, because at the end of the day, the EBO business still